During 2012, our terms of trade fell by around 20%. What this means is that the price of what we sell to people overseas has fallen, while the price of what we buy from people overseas has not. This is rarely a good thing. When this happens, our international customers need to buy less Australian dollars than they did before, so the demand for Australian dollars falls. When the demand for anything falls, then usually so does the price. So when our terms of trade fall, it will usually flow through to the value of our currency. Australia mainly exports commodities. In fact, 60% of our exports are made up of resources. And historically, there's been a strong correlation between the international price of commodities and the value of our currency. The chart demonstrates this relationship going back to the month after our currency floated freely in December 1983. The green line is the Reserve Bank's Commodity Price Index expressed in US dollars and adjusted for US inflation. So this is the real international value of commodities over the period. We've made the average equal to 100 on the left-hand axis. The blue line is the value of the Australian dollar compared to the value of the US dollar. And looking at the right-hand axis, you can see that at the end of 2012, our dollar bought almost $1.05 US cents. And that back in 2000, you would have only received 50 cents for one of our dollars. The correlation between these two lines is 85%, and this implies that changes in commodity prices have explained 85% of the changes in the value of our currency since it floated almost 30 years ago. But it doesn't explain all of the changes, because as well as currency transactions resulting from trade, there are also transactions for capital movements, so there are periods of disconnect. For example, in the early years of the last decade, we had the technology crash, and even though the market problems were mainly overseas, the economic disruption saw capital fleeing to what was regarded as the safe haven of the USA. And the same thing happened in 2008 at the height of the global financial crisis. But at the end of 2012, capital was flowing in the opposite direction to access our comparatively high interest rates and our nation's AAA credit rating. These capital flows have kept our currency stubbornly above $1 US. It should be noted that periods of disconnect with commodity prices have never lasted for more than a few years. For the connection between the value of our currency and commodity prices to be restored, either the value of our currency will fall or commodity prices will increase. It's not the demand for commodities that's the problem. The developing world is unlikely to stop growing, and even if the nature of their growth changes, it will not necessarily mean that they want less of the stuff that we export. What's causing prices to fall, and potentially fall further, is the increasing supply of raw materials. An enormous amount has been spent here in Australia to increase the amount of raw materials we can produce, and an enormous amount has been spent in other places as well. The price of commodities will drop as the supply of commodities increases, even if the volumes remain at the same level. So we don't expect a return to the high commodity prices of the recent past, and therefore we expect the value of our currency to fall. We just don't know by how much. Commodity prices could weaken further. If this happens, our currency could fall to somewhere between 80 and 90 US cents. Mind you, a lesser fall is certainly possible, and a greater fall wouldn't be out of the question.